Hi guys, hi everyone. As I promised to some of the guys in the Discord channel, I'm gonna do a video with three topics. What I want to review today is, first of all, I want to do like a concepts review because I've seen a few guys which are new um, with gamma trading with gamma exposure. Um, the language is different, the concepts are different. Futures traders are usually thinking in linear terms. And when they come to the channel and we use um, all these concepts, some of them are coming from the options market, but other concepts are concepts that we use in Getsbox. Like the guys in Getsbox, they're kind of developing this. You're not gonna see this kind of analysis anywhere else in the market because that's proprietary from Getsbox. And that's what I want to do this video. So I kind of want to do some concepts review at the beginning, like the first part. The second part, I want to do an intro to order flow. Um, why? Because it's an amazing concept. It's an amazing way to see when we get flows into the market, and basically when we get these flows that basically affect the whole option change. Not only one strike, a couple of strikes, but when something big comes into the market and basically that changed everything. And what I have seen, this is fantastic because basically marks the top or bottom of the charts of the price. Sorry, and learning how to use it um, is challenging, I think, and it's because of the language and because of changing the mentality of thinking in linear terms, and then moving to non-linear and thinking what's happening in the options market and why or what are these guys doing, right? These options traders, when they came into the market, they usually don't came like buying a call, selling a put. They came with complex structures, and they came in so many different ways. They could actually sell futures and then buy options on the upside to get protected, or the other way around. Other came into the options market to hedge their portfolio. So it's very difficult to actually see strike by strike what's changing. So I think this is fantastic tool. This is a very clever tool, to be honest. I've been using it for a couple of weeks, and telling you is amazing. I've been making some very good trades, and I'm gonna show you later. And that's gonna be the third part. I'm gonna show you a review of the trade on Friday. Actually did like 4 trades on Friday. All of them were very good. Some of them using the what we know already of Getbox, like Gets Profile and Options Profile, but two of them basically very good trades were using order flow. So let's gonna start with the concepts review. Um, Gets Profile. When you think, or the way I like to trade is I want to trade where I see flows coming into the market, important flows, right? I don't want to trade anywhere else because I know I'm gonna get stop out. Um, where the market is happy trading in certain levels. I want to interact in the market when something big came in into the market, when a flow came in into the market. So basically, this gets profile measures the net imbalance of transactions so far in that day of calls and puts, right? So it's an excess. It doesn't measure everything. And what I mean by that, if um, let's say a client buys a call and the market maker match that buying with a selling from another client, right? That is not going to be shown here. We're not going to see it here. Why? Because that doesn't have an effect in the system. Someone bought a call, someone else sold the call, market maker was in the middle, he did a very good job. he matched the two, buyer and seller, and that's it. Nothing happens. It's just a transaction went through. Um, so basically, what we want to see is when a flow came into someone buys an option. Let's put as an example, and the market maker didn't match that with anyone in the market. So the market maker had to warehouse that position and hedge that position, right? So market maker needs to be delta neutral. And in order to be delta neutral, he needs to get out into the underlying, which is the futures, to actually buy or sell to be delta neutral. And then the forces of gamma, as the price moves, is telling him how much or how much more he needs to buy or sell in the futures market in order to be delta neutral, right? So I think this is a very clever way to see this, because what we're seeing is excess of gamma, and that's what you want to see when you trade in the market. You don't want to trade again in random places. You want to trade when big institutions or big flows came into the market, and that's what these guys in GetSpot they do. They their algorithm, basically what it does is just um, it kind of filter all the flows and basically showing us what's important, right? And they put it here like that: gets profile nets out imbalanced calls against imbalanced puts, right? And this is something very important. Don't think, oh, this is the client, this is the market maker. Just don't think of that. Just think this is an excess of gamma, and it's gonna give you some targets, like the local areas, which are these ones, are like points where the price is going to move through it very easily. And then it gives you some targets, right? Where are the major concentrations of this excess of gamma? So to sum up, this is the net imbalance, right, of transactions, right, where we can see excess demand or excess supply, and we can see, and is the graph shows excess of gamma, right? And don't think again this is a market maker or client. Don't think about that, forget about that. Just think about this is and levels, excess of gamma, where big flows are coming in and affects the market, right? So again, I'm gonna repeat this again. So on the left hand side we have the put gets imbalance. On the right hand side we go the call gamma exposure imbalance, right? So basically help us to quickly identify these high gamma nodes, like this one here on the positive, on the call gets imbalance, and this gamma node here on the put gets imbalance. These are targets, right? And the low gamma nodes are like transition areas, right? So if we have, like, are we seeing here like positive, or this green, don't call it positive, sorry, this call gets imbalance, which clearly is more than the red one. This is for Friday. We can actually see that the regime is a call regime. So the probability the price to go up is higher than the probability of the price to go down. And as you can see, this is these lines are here at the spot on that day, the whole day. You can see that despite it wasn't an easy day, the price basically found some support on this major maximum put gamma, or maximum negative gamma, let's put it that way, and then it went up, right? But it's mainly because the regime was positive regime, right? So now, what's important for us futures traders? We need to have a map, and this is the map. We know that this is a positive regime. We know we got areas where the price might find reversals, right? And this is something that we need to get used to. We don't talk about supports or resistance, but we talk about reversals of momentum, right? And we're gonna see this later on. But this is what we need to read, and this is what we need to understand from Get's profile, right? Don't think again about client market maker. Don't think about that. Just think about, okay, what's the regime? okay, I got lots of call gets imbalance on the right hand side compared to the put gets imbalance, right? And I got some important targets, which are the main ones, which we can see here. And then we go the transition areas, which are these ones here, the small gamma nodes. Now, I hope that's clear, but now we're going to talk about convexity ladder. What the guys at Getbox they are doing is like they were happy with this gets profile, but then they say, okay, we want to see not only these regimes, these targets, but we want to see levels where important levels with positive gamma, because we know that on these positive gamma levels, the price is going to move, right? And so they did this convexity ladder, and basically what it does, again, it takes the imbalance of transactions so far that day for 0 DT options or 1 DT options, which is more or less the same as before, but what they do different in they display the net gamma exposure of those positions, and that's why if we compare to the guest profile where we have all these nodes of call gets imbalance and put gets imbalance, here what we see is basically calls positive 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 excess of gamma and negative excess of gamma. But to be honest, the most important ones and the ones I use and we use in the channel to trade are the positive excess of gamma. So long calls and long puts represents long customer gamma exposure, right? So these cyan bars are long calls and long puts. We don't kind of see or differentiate, oh, this is a long call, so the price might go up, or this is a long put, so the price might go down. Because you have to think in the options market, they don't trade direction, they trade volatility. And what they want is they want the price to move as far away as possible from this long, let's say, positive convexity, right? This one. They want the price to move as far as possible from these levels. And the short calls, sorry, the purple ones are short calls and short puts, right? And that represents the short customer gets. As we know, and I'm going to show later in the next slides, we don't trade on these levels, right? We trade on the positive ones because we know price usually move away from them in the upside or downside, and it moves and it tries to find the next one and the next one, the next positive, and then the only important level that I personally take into account is the max negative convexity, which is depicted like this, is highlighted like this in purple. So we can see the max, the positive, maximum positive convexity and the maximum negative convexity, right? So what does it mean? It means that in positive convexity, customers own convexity, right? And they favor moves that exceed expectations, right? And as I said before, they want the options market. They don't care if it goes up or down. What they care is the price to move as far as possible, as far away from their positive strike as possible, right? In negative convection, customers are short convexity, so they're selling options, right? And what um, they want moves that underperform expectations. It's all about expectations. So on the positive, they want move that exceed expectations, and on the negative side, they want moves that underperform those expectations, right? And if you guys think, probably some of you guys know, some of you guys don't, but when options participants, traders sell options, it's because they expect the market not to move that much. Sorry, not to move that much. So they want the market to just stay there in range, so they can collect premium or they can whatever they do. But um, they want the price basically not to move towards those strikes. But if the prices start to move towards them, um, we're gonna see this. This is only an intro because of the hedging activity, right? Um, top, let's say from the market makers or even the clients themselves, the customers themselves, because they don't put an option and they just forget about it. Sometimes most of the time, they hedge these options, or these options are the hedge of their own positions in the futures market or somewhere else. So it's like if the price get to these short positions, like short options, they need to hedge and they actually put the price up in this case, right? And if it goes to the next one, they need to hedge and basically the way they hedge is they need to buy futures, so they move the price higher and higher and higher, right? So the important part here is to understand that um, when we think of this positive excess of gamma, they can act as an areas of resistance, right? Or support of resistance. What's important is we know that once the price interact with these areas, we know that the price is moving as far as way as possible, right? And that's why in the documents of Ketbock they say like think of it as a way to distinguish between areas of resistance, right, which are these ones, or areas of ease of movement, which are these negative convexity, right? So again, that's why we only enter, or personally, I only enter the market when the price interacts with this positive excess of positive convexity, excess of gamma, or excess of convexity, right? Only on the cyan bars is when I enter in the market. And as I said before, the regime is important. And I tend to use the convexity ladder along with the gets profile, right? So if you guys see this gets profile, these positive green bars, right, are basically all these purple bars here. Okay. What is that telling me? That's telling me that all these green bars, which we know are called gets imbalance, are actually short calls, right? So these are short calls because what the negative convexity is telling me is that um, these purple bars are short calls and short puts. So the green bars in gets profile is telling me, right, this is a call gets imbalance. And then the purple bars is telling me, okay, but those call gets imbalance are coming from short calls, right? And that's what we put in the channel that's used for the market, right? Because if the price start to go up, towards those levels, which are magnets, and this is something I'm going to explain in a different video. This is only an intro, but all these purple bars are magnets, are used for the price to continue up. So how I trade? I only trade when the price, when I see these cyan bars, and I know there is excess of gamma here. There are flows coming at these levels at this time. And I know the price wants to move away from these cyan bars. And also, I know the regime is up because I go all these call gets imbalances. And also, I know that they're coming from short calls, which are used for the price. Because as the price moves towards them, they need to hedge these positions. They need to hedge these short calls. So the way to hedge it, again, don't think about market makers or customers. The way to hedge it is they need to buy futures in order to hedge that short calls, right? And that's what makes the price go higher. Um, right. An easy way, and this is the object, this is what I want to show here. So the easy way to see this and to trade with this convexity ladder and gets profile, and especially the convexity ladder, is we all know about volume profile, and this is something we've been talking about a lot. right? So when you in the volume profiles, what you do, you have the low value nodes and the high value nodes. You want to trade on the low value nodes, right? Because you know they're mean reverting. There are areas where, or there are levels where the price is not happy to stay there. And if the price goes down and goes to the low value node, basically tries to come back to the high value node. We know that for volume profile, and most of the futures traders, I'm pretty sure most of us studied this before. So when you think in the convexity ladder, think like that. Think that you want to trade on the cyan bars, on the positive convexity, right? Because they're going to be the low value nodes. Uh, you want the price usually is going to come to this. If the price is coming down and it gets to this level, most likely it's going to bounce, right? Or if the price is coming from below and it finds some, um, let's say, resistance, but it managed to go higher, it will go up and it will try to find the next important positive excess of gamma here, right? And why is it remember that we need to remember that the option guys, they don't trade direction, they trade volatility, right? And they enter the market with different structures, and in when the market maker or even themselves with the customers, they need to hedge their positions, they move the market away from these areas. So for us, and I think this is very clever, what the guys at GetBooks are doing is they create this code where actually we can see what's important, right? And one of the guys asked me in the channel, well, how is GetBooks help me to trade better? And I said, listen, it helped me to trade better because most of people think that trading is like, oh, market opens at 9:30 and I have to be in and out in the next minute. No, I just have to wait for these important levels. Why? Because I want to interact in the market where big on or important flows are coming in. And where are those flows coming from? Big institutions, like big players, right? They are defending levels or they have interest in certain levels and they come into the market at those levels with these big orders. And that's what this is so good, gets good to identify these levels. And then um, so what happened? This is transition between positive and negative. So if the price managed to go higher, it will try to find the next node, right? And if it managed to go higher, it will go to the max negative excess of gamma, which is this one, and you will see friction here, right? That's why it's being highlighted because we know it's friction there. Is there are flows there which are important, okay? And remember, these are most likely these sorry, purple bar on the left, which is a short convexity, is a negative convexity coming from short options. If the price doesn't find resistance here and it continues to go higher, most likely by the mechanics of the options market, by the mechanics of the market makers and even the customers that they need to hedge these options, the price might go and it will try to find and it will try to go to the next important excess of positive gamma here, which are the low value nodes. And most likely, and this is something that we talk in more advanced videos, the price will find resistance here and reverse, right? You don't want to trade, as I say in other videos. Um, it, it, it is not that you cannot trade, but um, you don't want to trade on these negative convexity on these ones. Like trading on this small negative convexity is the same as trading on these high value nodes, right? And this is where more traders get stopped out because they think, oh, price is gonna go down, it goes down a little bit and then up. And then they think, oh, price is gonna go up and then it goes up a little bit and then it comes down. Why? Because they're trading on these high value nodes where buyers or sellers are happy trading on those levels, and the price is just doing this up and down, up and down, up and down, right? And that's where you get a stop out. So you don't want to trade this. And these high value nodes is similar to these short gamma nodes, the small ones. And as I said before, the only one which I consider important is the maximum negative convexity or maximum negative gamma node, right? This is the only one I care. This is the only one I see. Even to take profits, either to take profits or see if it's managed to go higher in this case and go to find the next positive gamma. If there is no positive gamma on the top, let's say we have this scenario, but there is nothing, there is not this positive bar here, most of the time, I'm 90% sure the price will go to this negative gamma and stall there, and it will find a reversal there, a resistance there, because there is no positive gamma to kind of attract the price, um, to kind of call this price higher. Okay, so now the other important concept, which is very nice, is like it helps us to understand in what sort of volatility environment we are, right? So a significant, well-distributed negative convexity, what is that telling you? That's telling you that this is a liquid market because traders are happy to sell options, right? So when you see this is because you see lots of options selling and traders are happy to sell that because they think the price is not going to move that much. So they sell options, right? When we have the positive convexity, well-distributed positive convexity, we know what happened. We know that options traders are buying options, right? Why are they buying options? Right? Because indicates an elevated and well-informed expectation of volatility. And if you think about when we have FOMC, right, when we have non-farm payrolls, when Jeremy Powell is speaking, the day before, we see the market buying options because they want to buy protection, right? Or we see a couple of days before that. But that leads to something that I'm gonna talk, in the future videos, is a little volatility crash after the event. So all the participants, let's say when you guys know when Jeremy Powell talks, sometimes they really move the market. So people who has a portfolio or who has positions in other, let's say, in other assets, they need to hedge their assets, they need to hedge their positions, and they come into the options market and buy options. And that's why you see this, right? But then after the event happens, let's say when after Jeremy Powell speaks, we have something called, which is the volatility crash, which is like all this volatility basically disappear. So this is kind of a little bit of review of the concepts of convexity and Getz profile. And now what I'm gonna do a little, I mean, not little, but I'm gonna do an intro into order flow because I was thinking about this and it's like the way to, let's say the futures traders that trade with moving average, that's basically like kind of the main dimension number one. Once you start to trade with a structure and try to learn how actually the market moves, let's say that's dimension number two. When you start to trade with Gamma and Guessboot and start to understand the mechanics of 0DT represents 50% of the daily volume of the options market, when you understand that market makers in their hedging mechanisms, they basically affects they affect the futures markets, right? And when you understand all these gamma exposure concepts, and when you see how Guessboot, with all their proprietary ways to filter the information and to show us all the excess of gamma targets, transition areas, that's kind of dimension number three. But order flow is dimension number four, and it's amazing because what happens? We cannot see for sure when someone came and buy a call, say a call, buy a put, or sell a put. Why? Because sometimes, as I said before, options trader came into the market with a complex structures that involves several buying or selling of options, different strikes, buying a call, selling a put, credit spreads, debit spreads, iron condor, debit iron condors, straddles, strangles, name it. There are so many combinations that can come into the market. And we cannot see that, right? So these guys at Getbox, Jazz and John, they were very clever because they say, okay, how can we actually see what's happening in the whole option change, right? And when you see the Gets profile, it's very difficult to kind of, oh, you go like, I don't know, 10 green bars, 5 red bars. How can you actually measure that? So basically they create this amazing tool which is order flow, right? And you can visualize the not only level by level but the whole, when you can visualize when big flows enter the system, right? These big flows enter the system not only in different strikes, sorry, and through various options structures, and you want to see that because that creates some uh, effect in the futures market, right? So what's we're gonna look into convexity order flow and Getz order flow. Why? Because you need to look them together, right? I'm gonna leave this for the future explanation. But what is convexity overflow? Is basically I'm gonna explain it here, and this is an example that we go from the guys in the channel. So convexity order flow is when we have long gamma. So the long gamma are the bars um, on the top, right? All these bars on the top are long gamma. That basically is telling us that whatever flow is coming into the market, they are taking liquidity. But bear in mind that taking liquidity in the options market is very difficult, is very different than taking liquidity in the futures, right? Because in the futures market, um, when let's say for in this example, when the price is coming down and someone say, oh, they're taking liquidity, what you think is like, okay, price is coming down, there might be some limit buy orders, big limit buy orders. And if the market is coming down and they take that liquidity, basically what would happen, the price will continue trading lower, right? And in the futures market, like futures traders, when they think, okay, takes the market is taking liquidity, they think the price is going to continue lower. But in the options language, when we talk about that the market is taking liquidity here, first of all, we're talking about positive gamma, right? So positive gamma means they are buying options, right? So we are buying options here, which means reversion, right? Why means reversion? Yeah, sorry, reversion, because the market, remember the market maker is the one who actually is the counterparty for these customer who bought options. Let's put it in this way, both options, right? We're not talking about, oh, he bought a call, he bought a put. All this is telling us is someone came and bought options, right? And is taking the liquidity. What it means that he's making the options below this more expensive, right? Is like the market maker is selling the options, and if someone came and bought those options, the market maker is the counterparty for that transaction, so he needs to warehouse that flow, hedge that flow, and on top of that, he needs to increase the price of that options below that. We can see that in the volatility skew, but again, this is for another video. But this is a very simple intro to say when you see this long or positive long gamma, which is positive gamma, is someone buying options and it means reversion. Like if we can see in this example, the price is coming down, right? Start to have some kind of consolidation here. And then we saw this big long gamma, and that's it. That's the start of this nice rally because it's a reversion, right? So basically, the regime has changed. Now, what is the short gamma? The lines below or on the below the zero line. That basically is options participants providing liquidity. That's negative gamma, right? It means that the options players are selling options, and that's momentum, right? So the regime continues. If you see here on this nice rally, you see these big spikes on the downside. That's momentum, right? Now, we need to combine with gets profile, but just bear with me one moment. Now, so again, long gamma is positive convexity, is when the market or the options participants are buying calls. So it's long calls and long puts. What's the logic behind? The logic behind is the participants are expecting a change in current conditions. So the price is coming down, right? And remember, options traders, they don't care about direction. What they care about is volatility. So when we see this positive long gamma, they're buying options, they're buying volatility because they're expecting that the previous state, whatever it was, is going to change, right? So they buy volatility because the change of this creates volatility. So for us to understand this and to trade this, we only have to think wherever we see a positive long gamma, positive convexity, we know they're buying options. And for us, that's a reversal. And that's the regime change, right? We're coming down. Now we're going to change that. Now for the short gamma is the negative convexity. So market participants in the options markets are shorting calls or shorting puts, right? So the participants are expecting no change in the current condition. So they're selling options. So they're selling volatility. They want the price to stay as it is. They don't want big moves in the market. What it means momentum, and it means that the regime continues. And we see it here in this example. We're going to see more examples, but we see it here. Big spikes down means the momentum continues. Now, what's the easy way to remember it, right? The easy way to remember is every time we see this convexity speaking up, think of reversion, right? And every time it speaks down, think of momentum, right? On the way up is a reversion. If the price is coming down and we see this, it's a reversion. And if it continues to go down, we want to see these short gamma lines on the downside always. Now, as I said before, we need to watch it together with gets order flow. And what gets order flow basically is a measure of calls versus puts. That's it. There's nothing more. So when we have positive gets, right, we talk about the cost of upside has been lifted, and this is called gamma. But basically what it means is the upside got more expensive. And if something got more expensive, basically you are thinking, oh, it's going to reverse because it's getting more expensive on the upside. When we see the down yellow lines, it means a negative guess. It means that the cost of downside has been lifted. What it means that the downside got more expensive. So we want to see a change on the move as well. So let me explain it better. So we need to have a look. In order to trade with order flow, we need to have convexity order flow and gets order flow together. Let me show you an example. And sorry, let me go back to this. So for instance, on this example, the price is coming down, right? And we go a spike up on the convexity. What it means that someone is buying options, they take in liquidity, and that's a reversal. And now we have the gets order flow on the downside, which means on the downside means that the downside go more expensive. And if the downside go more expensive, it means that there is no incentive for these participants to keep, to keep going down or to keep betting that the price will go down. So this is a perfect combination for a reversal, and we'll see an example later on in one of my trades, right? But you see, this is the combination you want to see for the price to move up, right? Now, this is what happened, and this is kind of the two kind of main setups that you have to have in your mind. If the price is coming down, right, and you see a positive convexity, which is reversion, and you also see downside guess, which is basically telling you that downside go more expensive, that's a reversion. That's where you see these moves. And, and this is a clever, so clever way to see these flows because telling you, no other service, no other kind of platform or no other um, algorithm that shows gamma exposure is gonna show this. This is a very clever way to see it. Actually, one of the guys was telling me, "Oh, you know what, Freddy?" Because I was talking about my trade that I'm gonna show you in a minute. I was looking for that trade and I didn't see it because when you have this positive when you have this positive convexity with no options participants are buying options. We don't know what it is. We don't know if it's a call or if it's a put, but we know they're buying. But when we see the negative guess, we know this is kind of a put, right? Because this is a long put, right? But that's not a way to see this, right? Because if you think about, oh, someone is buying puts, you expect the price to go down. This is not the way to see it. The way to see it is like in the whole option change, these flows came in, right? And they're affecting the price. And we know that this upside convexity is a reversion, and this downside gets is telling me that downside go more expensive. So there is no incentive to keep buying lower than this in the options. So that's when we see these reversions, right? Now, if we continue up, right? So we have the reversion and the prices start to trade up. What we want to see as the prices start to go up, I want to see these bars, convexity bars down because they are momentum. Remember, guys, when we talk about this, um, think about the short gamma, the negative convexity as momentum, right? So if the price continue to go up, what I want to see is momentum. I want to see negative bars on the downside. Now, the other scenario is like price is going up, right? And we see again spike on this positive gamma, right? And we see a spike up on the gets. What it means, again, positive means reversion, and positive yellow means upside go more expensive. And what happens with if the upside go more expensive? It tends to reverse. So that's basically what we see in the market. And I'm gonna show you some examples in a minute. And once the prices start to trade lower, what you want to see on the convexity or the flow is you want to see all these negative bars, right? And that means momentum. Now, I'm going to give you an example of this, which is actually on my trade on Friday the 14th. Um, this is me. I like to do my analysis with daily levels because I have noticed with all these years' experience, there are levels that big players or the market tends to defend or not. So the level I was looking at was the 22.09250, right? Why that level was important to me, and this is a way to confirm again, my main setup is gamma, but I like to see these levels because look what happened. This level was a resistance on this day. This is a daily chart. Again, on this day, it was a resistance as well. It tried to break above, but it couldn't. Finally breaks, and again, a few days later, it was a resistance again. So it was a resistance, resistance, resistance. Then it was a resistance again, almost resistance. And this is the bar on Thursday the 13th. And we can see that also works as a resistance. So Talking a little bit about market structure, this resistance, if the price managed to break above the resistance, is going to be a support, right? That's probably one of the simplest market structure concept that everyone learns. Support becomes resistance, resistance becomes support, right? And it has a logic behind. So I was looking at this level, 22,092.50. Keep that in mind, because if the price managed to trade above it, it's going to be a support, and that's what I want to trade. I want to trade on the upside. So this is the 15 minutes chart, right? So we can see in the 15-minute chart, um, price try to interact with this level, break above, come back and break above again, right? This is just before the market opens. So I was watching this and I was watching my level to see how the market interacts with this, and I was waiting for the gamma. Basically, all I do was waiting for the gamma. So this is the option profile at the end of the day, right? But what I show you this, I want you to show and I want you to pay attention to this yellow line on the bottom. That's the 22,092.50, right? That's the line. And see how the line works as a support during the whole day. But anyway, my trades, um, I'm sorry. And this is the overnight high, which was very important, right? So overnight price tried to break this level. Obviously, this is the Friday trading, so the overnight high came from somewhere on the left. But see, that was an important level. But anyway, back to gamma. So this is my trade number one and trade number two, which I made only looking at order flow, right? And it was a short scalp. I do two types of trades. One which is very quick scalps, and ones which I take directional and I wait for the market to hit my targets. So the short scalp with 1 minute, I did it one NQ each time, is using order flow, right? So what was the logic? Market opens, right? Start to go higher. Look, once we got this positive convexity here, right? And we got this with these positive gates. Remember what we say about positive convexity and positive gates? Positive convexity means reversal of the previous move, and positive gates means the upside got expensive. And look how the market basically reversed on that flow, right? The logic behind is someone big, someone in the market came here with this flow. We don't know what it is. We don't know what the structure is. All we know is that makes the options above expensive, and by convexity, we know this is a reversal. So the price reverse, right? And also we have this max negative gamma, and we got this call gamma, right? So I can tell these options is short calls, right? So I don't care if it's a short call, a long call. All I care is the market, the price interacts with these levels, and I know the market wants to move away. The price wants to move away, usually move away from these levels, right? So we have to kind of have a downtrend, and look what happened at this time. At these levels, we have this massive negative convexity with positive gates, right? So negative convexity means momentum, right? So it means that the down move will continue, and the positive gates means the upside keeps getting more expensive. So if the upside keeps getting more expensive, it means there is no an incentive for the guys in the options market to keep buying higher. And also I have a momentum of the downtrend. So basically I sold here for a quick scalp, took profits around here, and then the second time I saw the same situation. Look, negative convexity, which is momentum from the downside, from the down move, and also gets positive, which is cost of upside is getting expensive. So I go my second short scalp, right? It was a quick scalp because remember, we have this big support, which for me was important. So basically I scalp all this way down from 22,100 more or less to 22, just a little bit, 22,099, 98, I remember. So that was my first two scalps. And as you can see, when I do it with 1 mini, I mean, it's good money just for a quick scalp. But without this tool, I wouldn't be able to do it because I don't know, it's like betting, like going to the casino. But when we have this kind of information, it's telling me, oh, you know what? There is someone important. Look the size of the bars. Someone with is making is getting into the market with big flows, and they're affecting the market. They're affecting the volatility surface, and they're affecting the whole system. All right. So that's what I want to interact with the market. I want to interact here when I see these big flows. I don't want to trade here. I don't want to trade here. I don't want to trade here. I only want to trade when I see these big flows. And that was a nice scalp. So that was a combination of momentum, right? And a combination so for convexity, and that was a combination with gets gamma exposure, which is the upside got more expensive, as we can see it. Now, this is my trade number 3, which I went long at this level, basically because I have this excess of positive gamma, right? And remember from the slides that we saw before where we compared this gamma with the volume profile, I only want to interact in the market with this excess of positive gamma, right? So price went up to the market, we start to get this gamma, price cross the gamma and then recovers, right? But if I show you something really cool is this is the trade, right? This is the gamma. This line here, and when I went long, is basically this line here. And the price, interestingly, that's very cool. The price went, and guess where it found support, right? It found support on my level, 22,092.50, right? So basically, the price went up on the when the market opens, came down to this level and found support. And that's something amazing. I don't know. But when you combine this, I mean, I always like to analyze my daily levels because I think they're important. And I think market participants are are defending those levels. And when you combine that with the power of gamma, it's amazing. Look, price went down to the tick on that level and then reverse. And this is when I went long, right? And I keep my long and I put my stop loss below the level, right? Because if the market trades below the level, that's it. It's a resistance. It didn't manage to change regime from resistance to support. So that's where I put my stop loss just below that level, 2202.50, right? So that was my trade number 3, and I hold it for hours. um, but you guys think why I hold it, and this is very important. I got my hypothesis was these guys here, these options traders, whoever it was, change their flows from this positive gamma to this one here, right, at this level. And that told me, okay, the way I was thinking, sorry, is like, okay, they're changing gamma to the upside. So basically they want the price to move higher. But what really, really helped me to hold this position for hours was this, right? So if you guys remember the Gets profile, look all this positive gamma. That's basically, again, sorry, this positive excess of gamma. That's basically telling me if I compare this um, positive excess of gamma with this negative excess of gamma, what is this telling me is like, okay, this is an uptrend market. And the probability of the price to go higher is greater than the probability to go lower. I mean, it's very clear. and this is the target, 22,234, because this is the peak of the max positive gamma level, right? And that's why this is so good, because it helps us to see the transition areas and the target. And the price move, it wasn't easy, to be honest, because basically the price started to move after 12:30 on the way up. But this was telling us from, this is at 11:30 in the morning, is a lot of juice on the upside, right? And these are magnets. So in another video, I'm gonna try to explain why these are magnets, especially because these are short calls. All of these are short calls. But on Get's profile, the classification is basically saying, yeah, but this is juice on the upside, and I'm gonna explain why later. But it's because, just to give you a quick explanation, is as the price move higher, you know all those guys who short these calls, they need to hedge. So they're going to buy more, and they're going to buy more futures, and they're going to buy more futures. But the easy way to see it here is green, which is, this is an excess of there is an imbalance on calls on the right hand side, which we saw in green. So basically this is juice for the price. And on the downside, we don't have nothing. I mean, look, it's nothing. So the probability for the price to go lower is minimum compared to the probability to go higher. So this is what we call upside regime, right? I hold the position, right? Even though I enter here at this time, which was, sorry, it was around, um, it was around 10 of 5 of 10 of 10. I hold my position until almost 20 past 2 in the afternoon. And the only reason I hold my position was for this upside regime, and it was also because this positive excess of gamma on the top, right? So I was holding there, I have my stop loss below here, and look what happened at 12:30. Price went to this level, which was defended, that was the 22,092, which is this level here on the dailies, again 22,092. So the price got there at 12:30. And look how important is to read Guestbook and to learn how to read properly. So we have a reversal on max negative gamma, right? Look, price went to the tick on that level, right? And reverse. And that's what usually happens of these negative levels of gamma, maximum levels of gamma is the only ones we care. And when you see the option profiles, they do it for you. They do the filter for you. You don't have to care about, looking somewhere else. You see it here, you see it here, and you see it here. The price went to that level, and basically to the tick, it found support. But what's more important is, one, this is the level, the daily level they were defending, 220292. There is a gamma there, which is more important than anything else. It's a max negative gamma, which is acting as a support. And look what order flow was showing me. It was showing me the setup for gold long. We have positive convexity, which means buying options, which means reversal. And when I combine with Get's profile, with negative Get's, sorry, basically liquidity taking, the negative guess is telling me, oh, this is a liquidity taking, which means the cost of downside has been lifted. So it's very expensive. Options below here are very expensive. That's a perfect combination for a reversal. So this is my trade number 4. I added to my existing long, and I went long here, another one, right? And no other system, no other kind of methodology is going to show you this. Some guys might, I don't know, if you move this in 5 or 15 minutes, they might show a hammer. And after the hammer around here, they say, oh, it's a hammer. There is an institution buying there. Go and buy. But look where you buy. You buy far away from where actually the flow is, you know. So this is very clever. Honestly, this is very clever. And if you want to see, oh, this, I want to see this option, you might not gonna see it. Why? Because these floors are kind of a proprietary algorithm from Getbook, where they say we want to measure when someone big came into the market with a structure affecting the whole option change, we want to see that flows because we cannot see, if someone came with an iron condor, that's like kind of uh, like combination of four options, like two calls and two puts. You're not going to be able to see this, right? But with this order flow classification is amazing because look, you can see it and you can go long, like blind. Just close your eyes and go long because this is going to go long. And when you combine with, I mean, personally, with my daily level and with the max negative gamma, you know, I'm learning this order flow. I've been working with this for 3 weeks or 4 weeks, and it's been amazing. And I'm pretty sure as I get confidence, I'm not gonna put one mini. I'm gonna put like 5, 10 minis on these levels because that's how good it is, right? So that was my trade. The target was 22,234, but I took profits around um, 20 past 2 or something like that. And I took profits for two reasons. The first one is I had to leave and I didn't want to stay here until the close the whole day. And the second reason I took profits here is like the difference between this big positive gamma and all these transition areas is quite big. So from my experience and from what I've seen in the market, in order for the price to move to this level, I need to see more gamma, more positive gamma here, more cold gamma, very close to this kind of gamma, to this kind of level. But if you remember the gamma that we saw before, all of these gammas that were more or less the same. So it was easy for the price to go up and up and up. And think of these gammas as magnets, right? So this is a magnet for the price to go up, all these little gammas here. But if there is a big gamma like this and we don't have, I think we talked about this in previous videos. Imagine this is a ball or this is a guy who is climbing a mountain. It's very easy for this guy to climb the mountain because he has, like these rock climbers. They can go very easily here, but from here to here, there is no there is no steps. There is no an easier step to move here. So I thought it was 20 past 2, I think. And I thought like, all right, so we have less than 2 hours for the market to close. And it's very unlikely that the price would hit this target because we don't have enough gamma. So basically I close my position here for a nice day. Um, I'm sorry guys, I know it's been a long video and anyway, if you got any questions, just post it in the channel. I'll try to do my best and to answer everything, but this is going to be another video about order flow. It's going to be in deep, more understanding order flow because honestly, this tool is amazing. And I've been talking to the guys, Jazz and John, and they've been so kind to actually teach me everything about order flow, which I'm gonna put in a video, and hopefully I'm gonna guide you guys step by step because it's so amazing. I never seen anything like this in the market. This kind of algos, this kind of algorithm. This truly is an institutional level. Some of you guys know I was a senior trader in London working for an investment bank. I was trading derivatives in the FX market, linear derivatives, and and I always say this the handicap that we have as retail traders is we don't have access to all these, sophisticated tools that investment banks have. Now we have it. We have a sophisticated tool with GetSpot, and not only that, but we have the knowledge from Jazz and John, and they're so good in the channel because they don't create this and they sit down waiting for get clients. They basically come into the market and they trade every day, Monday to Friday, and they are answering questions to all the traders, right? And hopefully with these videos I can help you guys also to understand more. So when you come into the channel, we trade, we trade, we post our trades, we explain why we took the trade, sorry, we put our targets. So basically it's very, very interactive. But honestly, this tool, this order flow and all the get votes is truly an institutional level, right? So I hope, guys, you like the video. Sorry, something is not clear, but please, if something is not clear, just send me a message, and I'll try to do my best. Thank you, guys, and good luck.